SoFi CEO Anthony Noto and our Kate Rooney join us now. Kate.
Thanks, John. And good morning, Anthony. Thanks so much for being here.
Good morning, Kate. Thanks for having me.
Great to see you. So this is a new feature on SoFi's trading app, but you guys will also be an underwriter in these deals. So you're working directly with the companies. Explain SoFi's new role here in the IPO process.
Sure. One of the things we try to differentiate SoFi Invest by is selection. And that differentiation started when we launched the product. We pioneered fractional shares and others copied us shortly after that. We then added SoFi 5 ETFs. And so we have the gig economy ETF, the TGIF ETF from SoFi. And this is another step in that path of giving our investors a way to build diversified portfolios and invest over the long term. Specifically, what we're doing is we're partnering with issuers to allow our investors to invest in new IPOs before they start trading on the exchanges. We outline all the details in our app and on our website, but this will give them access to portfolio elements that they haven't had access to before, initial public offerings. Obviously, initial public offerings are riskier assets than companies that have traded for a long time. So it's important that those positions that people take, SoFi members take, are a small portion of the overall portfolio. So we want to educate them on IPOs. We want to make sure they have access to IPOs and then ensure that they're investing over the long term in a diversified way. And this is a key element to that.
Got it. And Anthony, I know you spent time at Goldman Sachs as a partner there. You know this process really well. But you'll be competing with some of the Wall Street funds here, whether it's State Street, BlackRock. They have argued that they might be better customers in an IPO. They're more likely to buy and hold, for example, while retail investors tend to get the reputation for coming in and flipping those shares. Could that reputation affect allocation that you might get for your investors?
First and foremost, what I'd say is we're partners with all the large investment banks. And so while we'll be an underwriter in several IPOs over the coming weeks and months, we're partnering with large investment banks and being part of the underwriting group overall. So it's not like we're trying to replace anyone from an issuing standpoint. As it relates to investors, we've done a couple of things to ensure that our investors are taking a long-term view. We won't charge commissions when someone's allocated an IPO shares and they buy them. But if they sell those shares within 120 days, we will charge them a quite meaningful amount because we want to encourage long-term investing and not flipping. There are a number of other factors that will weigh into our allocation of future IPOs based on an individual's behavior. If someone is demonstrating a behavior that is similar to flipping an IPO, that will go against how we think about allocating to that person in the future. And so we'll factor in the things that large institutions factor in when they're doing IPOs as well, large underwriters, that is, which is what's the history of this investor? Are they long-term holders? Do they understand the story? Do they understand what they're investing in? And will they stick around when things get a little bit choppy? So
Anthony, I think that's so probably important because, Robinhood's going to get into this. Some of these other names will. And it seems to me, when I talk to these CEOs around the time of their IPO, this is exactly the type of investor, at least, the poster child investor that they don't want. So if I'm a SoFi investor, how do I differentiate myself so that Frank Slootman doesn't mind me buying in and doesn't think I'm going to flip this?
Yeah, the retail channel is increasingly a really important channel, as we've seen over the last several months. And so having visibility into that retail channel will help those companies that are doing IPOs better understand their shareholder base and make better decisions around pricing and allocation of shares. If you are an individual investor and you want to participate in IPOs, you can open an account on SoFi and display the behavior that you're a long-term investor. One that when you put in an order for an IPO and you get allocated, you keep those shares as part of your investment horizon over the longer term and not just flipping it because the stock has moved up on a temporary basis or otherwise. And as I mentioned, we're creating friction points on selling that is in many ways to penalize people for our flipping. And they'll be penalized in two ways. One, a charge, and two, an impact on future allocations.
Shepard Smith here. Thanks for watching CNBC on YouTube.